Good evening, you're watching Traders Corner, and joining me as always in studio is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, we were talking about the S&P 500 last week, and we alluded to a trade that you've enacted for the portfolio, a fairly complex trade. But the question is, if you think the S&P has run too hard and you think it's going to pull back, you'd probably want to be short of it, but how would you go about doing that?
Yeah, that's what we're going to talk about this week on the show. And it's an option structure. It's one of these, my famous option structures, which I know get very, very complicated. This is the first time we've ever done one of these on the offshore market, because we haven't traded offshore markets previous to this. We've always done our options on the top 40 index locally. So it's quite nice to go offshore, because the options markets there actually are way more developed than they are here in South Africa. And you can trade options on screen on a variety of different markets. Obviously, the S&P 500 being the biggest and most actively watched equity market in the world does lend itself to having quite a developed options market on it. So this week, we're taking a look at an option structure. Effectively, it's a short trade that I've done, but then I've created a hedge using options in order that if the market continues to run up, I'm not going to get carried out by being naked short on the S&P 500.
Okay. So, I mean, the technical setup there, it must influence your decision to have a hedge short against it. Yes,
well, that's it. Look, I'm going to talk about the technicals quickly and say, it's very overbought. We can see the graph of the S&P 500 on the screen here at the moment. What's very evident is that this market has been going up and up and up ever since Donald Trump won the US election. And in the last week or two, it's really gone up in a very almost parabolic fashion. It's getting extremely overbought now. You can see your RSI at the top there is in very, very overbought territory. And it does feel as if the air is getting pretty thin up here on the S&P 500 at the moment. And I did for a long time think that this probably was what was going to happen. We're going to see almost like a blow-off type of move to the upside, which might then well precede some return to reality. But let's see. From a technical standpoint, probably one shouldn't be shorting a market that's as strong as this. But I've got my reasons for thinking it might be an idea to do it. And also keep in mind, I'm going to be doing it in such a way that I've got my risk is very well contained by virtue of the options that we're going to be talking about.
So your reasons being, if you look at fundamental reasons, do you think it's just expensive and maybe deserves a pullback?
Yeah, look, it's not cheap. It's not outrageously expensive, but it is quite expensive. So from that point of view, fundamentally, yes, it's stretched. Technically, we had a little inverted head and shoulders type of pattern that formed there through December and into January, and that broke out earlier this year. And it's gone on to meet the target and then some. So we're now up at about 2350 or so at the time of recording this show. Which is, funnily enough, if you have a look at this next slide, it's more or less the average target for the year end for all of the Wall Street experts.
Yes.
So take a look at these targets that I picked up off the internet, and these are Wall Street analysts and their year-end targets for the S&P 500 for the end of 2017. And you can see, obviously, there's big names there: Goldman Sachs, Merrill Lynch, Morgan Stanley, Credit Suisse, Deutsche Bank, JP Morgan, Barclays, etc., etc. I mean, these are proper big organizations that do this stuff professionally. And if you have a look at the bottom there, you can see the average end-of-year expectation for all these analysts is 2359. So we're pretty much there anyway. Yeah. And it's only the middle of February, or we're approaching the end of February. So fundamentally, you'd think we are stretched. Technically, we are very stretched. And I also do kind of question this whole Trump rally and say to myself, he's come out with all these promises in his election campaign. He seems to be trying to go about enacting everything that he promised in his election campaign. But if you look at it, he's very much focused mostly on the protectionist side of his election campaign. He hasn't really addressed many of his economic ambitions. And one does wonder whether he's actually going to be able to push through some of his economic policies and ideas, or whether he's going to get blocked. And at that stage, is there not some reality that needs to come back into the markets and say, Donald Trump is now the president of the US. We've seen the S&P 500 rally close to 15% since he won the election. But is that justified? Or do we see some sort of retracement of this Trump rally? And I won't be too surprised if we do see some sort of a retracement of the Trump rally. I just don't know quite when it's going to begin, where it begins from. But given that there have been many technical targets of between 2350 to 2400, also take a look at all those fundamental targets of around about 2350. You start to think that from here on out, is there much more upside? So based on that, I've gone short of the S&P 500 CFD, and then I'm going to create a protection with an option structure around it.
Yeah. Oh, I was going to say, that I don't think there's much upside, and all those strategists should just cash in and then take the rest of the year off. But I suppose they can't. Got to justify their salary somehow.
Exactly, yeah.
Okay, so how are you going to justify your salary this evening, Garth?
All right, so what I've done, look, this graph now is a plotting of the profit and loss on the left-hand side and the levels of the S&P 500 on the right, on the bottom rather. So if you look at the bottom, you can see we've gone down to the level of 2,000 on the S&P, and we've gone all the way up to a maximum of 2,500. Okay. Right now we're trading at around about 2350. Now what I've done is I've gone short on S&P 500 CFD, and I've done a CFD that is $20 per point short. So, and I've done it at a level of 2350. So there's your payoff on a naked short position. Quite simple. It's a straight line, very linear. From our 2350 entry point, if the market goes down, you can see if it goes down by 50 points, we make $1,000. If it goes down by 100 points, we make $2,000, and so on. Consequently to that also is if the market goes up. If it goes up by 50 points, we're going to lose $1,000. If it goes up by 100 points, we're going to lose $2,000. Okay, so that's the concern about being naked short here. I'd love to be naked short if this market goes lower, but what if it goes higher? Because I can say it's overbought. I can say the analysts' targets have all been met, so that's all fine. Markets can stay irrational longer than you can stay solvent. So if the market does continue to move up, I don't want to be staring these kind of losses in the face where we're losing $1,000 or $2,000 or $3,000.
Because essentially that could, well, it wouldn't clean you out, but close.
Well, it could. We've started our offshore portfolio this year with £10,000. So to start losing $1,000 or $2,000 or $3,000, it starts to be it's too much. To be honest, the risk is just too great.
Yeah.
However, I can do this and then create an options protection structure around it, which allows me to be short without having to deal with the risk if the market continues to rally. And that's where options become very, very useful and very creative. So I'm going to get into the mechanics.
Slash is a euphemistic for very confusing too.
Well, yeah, very confusing. But now, as a well-known president once said, listen properly. And we're going to go through all of this now and go through the different legs of this option structure to explain how we get a payoff which gives us downside participation without having significant risk if the market continues to rally. So we've done that short position, and you can see that on the screen. Now that's the payoff as I've just described it. Now, in order to create the protection that I need to prevent me from being naked short from the market rallying, what I do is I go and buy call options on the S&P 500. So I buy 20 call options with a strike of 2350. So they're at the money call options, exactly at the level where I've effectively gone short. These options expire on the 21st of April. So we've got 2 months of time value, or effectively a 2-month timeline to hold these options and to try and see if the structure can work for us. I've paid $34.60 for each of those options. And remember, we've done 20 of them. So that means the premium that I've paid away is $692. I've effectively paid $692 in order to buy this call option. And notice on the right-hand side of the graph there, you can see how the payoff profile of the call option in the green there offsets the payoff of the short position.
In other words, if the market is to rally, you would be in the money.
Well, if the market was to rally, I would be neutral because I'd be losing on my short position, but I'd be making money at the same rate on my call. So effectively, those two offset each other. If the market begins to fall, however, you can see that I'm on the right side of that because my payoff profile on my naked short CFD position will play into my hands. Right.
But that is quite expensive, isn't it?
It is quite expensive, and that's the other reason why I need to do a few more legs to the structure in order to try and sell away some of the risks and sell away some of the wings, as I like to call it, on this option structure. So what I've done next is I've gone short now of a put option with a strike of 22.80. Also done 20 contracts of this as well. And for that, I receive premium now of $19.60. Okay. So notice how the payoff profile works. The above 2280 on the S&P 500, I'm receiving money. I'm receiving a total premium payment to me of $392. And then below 2280, that structure, that put option will start to lose money. But do keep in mind that by that point, I'm already making nice profits on our naked short CFD position. All right, so that would offset to some extent. But now I've paid away $692 for the call option. I've received $392 paid to me for the short put option, which is nice. So it goes some way to offsetting the cost of this thing. But my feeling is that I can still sell some more out the money put options in order to earn a little bit more premium. And the reason I'm comfortable to do this is because I don't expect the S&P 500 to fall massively, not between now and the 21st of April. I'm looking to try and take advantage of maybe a 5 to 10% pullback in the S&P 500 during that time. I'm happy to sell away some of the participation beyond that because I'm of the view that the market's unlikely to fall that far in the short window of time that we're doing this. So I've gone short more put options. I've sold another 20 contracts of put options with a strike of 21.80 now. And for that, I receive a premium of $8 for each of those options. So therefore, I'm receiving a total of $160 in premium for that leg of the put option structure. Okay, so I know it's starting to get complicated. I know my colleague Andrew Todd always tells me these diagrams look like the London Underground map, which
which is pretty accurate.
It's pretty accurate, yeah. It's going to get worse, I'm afraid. So I'm going to put another line on there, and that burgundy line, is that the right color? Burgundy
no, it's more magenta. Oh, actually, I don't know.
Okay,
red.
I'm colorblind, so it's red. It's dark red.
It's a thick red line.
Okay, it's a thick red line. Now, that thick red line illustrates the overall payoff now of all of this stuff combined.
Okay.
So that's our naked short CFD position and all the call options and put options and everything overlaid and combined with each other. That's how it looks. If I take and tidy it all up, that's how we look. So effectively, that's the payoff profile that I'm wanting to create now. If the market goes below 2350, in other words, if it falls from the current level where it is right now, I'm going to make money. I'm going to start earning a profit on this whole structure. Yeah. If the S&P 500 continues to rally and goes higher and higher and can go to the moon for all I care, the maximum that I can lose is my premium, which is $140. So I'm limited.
Yeah, you've quantified your potential losses.
Yes. So although I'm short, I'm not naked short because I've got this protection in place. In the event that there's a big short squeeze, it's not going to hurt me. If the market does come lower, then I'll start to make money. And from 2280 all the way down to 2180, I make my maximum profit, which is $1,400. And it doesn't sound like an awful lot of money, but in the context of our offshore portfolio, that would give us about a 12% return on our offshore portfolio, which is not too bad.
No.
I'd be very happy with that, especially this early in the year, to bank a 12% profit on our offshore portfolio. That profit does begin to erode below 2180, and then only below 2110 does the whole structure actually start to lose money.
Okay.
But if we overlay it onto that graph of the S&P 500 that we started with at the beginning of the show, it basically looks like this. You can see from 2150 down, we start making money. We make our maximum profit between 2280 and down to 2180. And then only down here at 2110, I'll then start losing money again. But that is a massively profitable area. And we're talking about the S&P. We've got downside participation here for up to a 10% pullback between now and the 21st of April. Okay, and our sweet spot is between a 3% and a 7% pullback on the S&P 500.
Yeah, so not a huge pullback, but potentially a very rewarding payoff.
Yes, correct. That's it. We're not looking for a market crash. We're just looking for a pullback.
Garth, we have to leave it there. And people can revisit this on the web and also watch the show throughout the week. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.